Okay, let's just dive right in. We're talking JPMorgan Chase Q4 2025. And for you listeners who follow the big banks, this quarter was it was a fascinating study in market tension.
Oh, tension is exactly the right word. You saw this clear, really significant strategic win, but it was just completely buried under the noise of these massive one-time charges.
And their future guidance.
And the future guidance, which led to that, 4% sell-off on the day?
More than 4%. So our mission here is to really guide you through the numbers that mattered and maybe explain why those policy risks spooked the market so much.
Let's do it.
So let's start with that immediate snapshot, because this is really where all the confusion began. The headlines were mixed, and that's what drove the stock down.
Yeah, the profitability metrics, they created some real whiplash right out of the gate.
So walk us through it.
Okay, so the complexity starts with the earnings per share. You've got the GAAP number, that's the official by the book number.
Right.
That came in at $4.63.
And that missed the consensus, right?
It did. It missed the FactSet consensus of $4.85 by about 22 cents. A noticeable miss.
But then there's the other number, the adjusted number.
Exactly. And when you strip out this one very large, significant item, the adjusted EPS comes out to $5.23.
Which is a beat.
A solid beat, yeah. It beat the LSEG consensus by 23 cents. So you have a GAAP miss and an adjusted beat all at the same time.
That is a huge divergence. So what was the driver? What was that huge item that created all this noise?
It was a one-time event, a massive $2.2 billion reserve build.
And let's be clear, this wasn't because consumers are suddenly defaulting on their loans.
No, absolutely not. This was a strategic move. It was all related to their forward purchase commitment for the Apple Card portfolio.
The one they're acquiring from Goldman Sachs.
Exactly. JPM had to set aside all those reserves immediately to cover the expected losses on the portfolio they're about to bring on. And that one action just masked what was underneath a pretty solid quarter.
Okay, that clarifies the initial panic. So let's dive into those core business drivers, and we can put a pin in the Apple Card noise for a minute. Net interest income, or NII, still seems to be that steady growth engine.
It really is. NII was strong, came in at $25.1 billion, which is about 7% growth year over year.
And that's being fueled by what? Higher deposits?
Higher firm-wide deposits, yeah. And this is a key point, an uptick in revolving card balances. So consumers are still spending, but they're using credit a bit more heavily.
Now, where the firm really outperformed was trading.
Oh, massive. Markets revenue was a huge standout this quarter.
How were the numbers?
They delivered $8.2 billion. That's up a very healthy 17% year over year.
And digging in, was it broad-based?
Pretty much. Fixed income had strong performance, securitized products, rates, currencies. But the real story, the headline grabber was equities.
Up 40%.
Up 40% year over year. That's just a huge number. It's a clear signal of strong institutional client engagement, and JPM was just perfectly positioned to capitalize.
And that kind of trading performance gives them a lot of ballast against, weaknesses elsewhere. So speaking of which, where was the soft spot? Investment banking fees again.
Yeah, IB fees continued to lag a bit. They were down about 5% year over year, missed the analysts' estimates.
And what was management's explanation there?
They pointed to a really strong prior year comparison. 2024 was hot.
Sure, tough comp.
A very tough comp. And some deal timing issues, but they seemed very almost bullishly optimistic about the pipeline for 2026. They suggested this is a momentary delay, not, a structural problem.
Okay, let's check in on consumer health, because that is the bedrock of their biggest division. Credit costs were $4.7 billion.
Right, but remember, $2.1 billion of that was the Apple Card thing.
So the real number for charge-offs is closer to $2.5 billion. Yeah. What was the tone from management on that?
The tone was steady. Resilient. They were very clear that consumer health and small businesses remain sturdy. They're not seeing any broad deterioration.
Spending is still high then.
Still high. Debit credit sales volume was up 7% year on year. That shows a lot of confidence.
So the consumer is stable. Let's shift over to the investment side, asset and wealth management, AWM. Seems like they're capitalizing on that market strength we saw in trading.
AWM had great results. Revenue up 13% year over year. And it was driven by market appreciation and, I think most importantly, huge long-term net client inflows.
How much are we talking?
We are talking $52 billion for the quarter alone.
Wow.
And over $500 billion for the full year. It just shows that in Uncertain times, clients are consolidating their assets with the biggest players, the ones with scale and perceived stability.
Okay, let's transition. Let's get to the parts of the call that truly define that negative market reactive, because it wasn't the core performance.
No, it was all about the future. It was about expenses and policy risk.
They guided to an adjusted expense outlook of about $105 billion for 2026.
Yeah.
That's a massive dollar growth number.
That figure is staggering, and you could almost feel it trigger the alarm bells on Wall Street in real time.
This is where JPM is essentially telling the street to just throw margin expansion expectations out the window for a few years.
They are, and they had to spend a lot of time on the call defending this aggressive spend-to-win posture. They're actively sacrificing that near-term operating leverage.
And their argument is what? That they have to.
Their core argument is that, look, continual operating leverage it's just mathematically impossible in a business like theirs.
Because of technology and competition.
Exactly. They said they must invest heavily in tech, in branches, in compliance, just to secure long-term growth.
Right.
They're not just fighting other banks. They're fighting fintechs, non-traditional competitors.
And the Apple Card deal is the perfect real-time example of this strategy. It's expensive.
It is. They're booking a huge reserve, and they need 2 full years for the integration.
2 years. Why so long?
Because it's not just a balance sheet transfer. They called it an economically compelling transaction, but it's a foundational technology rebuild. The Apple Card runs on a totally different tech stack that's integrated deep into iOS. JPM has to rebuild that entire experience and embed it into their own systems. They're betting that getting the PEC right, no matter the cost, is the real long-term moat.
Okay, shifting quickly to their income guidance, the $95 billion NII outlook for 2026.
Right, and that's X markets. It's based on the forward curve, which right now assumes 2 rate cuts.
So a fairly conservative assumption, which the market probably liked.
Yes. Another key point, and this has deep regulatory implications, was the whole discussion around non-bank financial institution lending, NBFI lending.
They confirmed it's grown a lot.
Significantly over the last 7 years. And they basically said the reason is regulation.
They're arguing the rise in private credit is a direct result of banking policy.
They characterized it as regulatory arbitrage. Plain and simple. For a bank, it's often better to hold the safest AAA-rated piece of a securitized product than to hold a direct corporate loan on your books.
And they pointed to the leveraged lending guidelines.
Specifically, said those guidelines constrained the banks and that seeded or accelerated the growth of the private credit ecosystem. It pushed loans out of the regulated system.
But what's really fascinating is their actual loss history in this space.
It's astonishing. They stress their loss history is minimal. They've had only 1 charge-off since 2018.
Just one.
One. And that was due to fraud. And that data point is why they're pushing back so hard against regulators. They're basically saying, we're better at managing this risk than you give us credit for.
Let's connect this back to the macro picture that worried the street. 2 big external risks really dominated the Q&A. Let's start with geopolitics.
Management flagged huge geopolitical risks globally, said it's the highest risk factor they track.
But on the flip side, they're still pretty positive on the U.S. economy.
Surprisingly so, yeah. At least for the short term, say 6 to 9 months. They're citing resilient consumers, stable employment, government spending. The only real warning was longer term, global debt deficits, which they believe will bite eventually.
Okay, but the most immediate threat, the one that really contributed to the sell-off, was the regulatory cloud around the credit card APR cap proposal.
This was clearly a huge priority for them to address. Executives warned that putting a 10% cap on credit card interest rates would be severely negative.
And they weren't just complaining about their margins.
No, their central argument was economic. They said the main consequence wouldn't be lower profits for them, but a dramatic reduction in credit access.
Especially for the people who need it most.
For subprime borrowers, exactly. They're arguing that a regulator trying to lower rates would accidentally push the riskiest consumers completely out of the regulated banking system. The economics just wouldn't work.
Okay, finally, let's talk capital. JPM ended with a CET1 ratio of 14.5%. That's their core safety buffer. But they really pushed back on being forced to hold even more.
They pushed back hard. They basically said running the bank with these huge arbitrary buffers doesn't make sense. They estimate they already have $30 to $40 billion in excess capital.
So what's their argument?
It's a philosophical one. They're saying the required levels are already set for maximum stress. If regulators want a safer system, they should focus on liquidity and resolution frameworks. What happens when a bank fails?
Not just hoarding more capital.
Right. They actually argued you could make the system safer with less capital if you manage other risks like interest rate exposure better. That is a direct challenge to the regulator's whole philosophy.
All right, time for our mandatory This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on all this.
Okay, so the market reacted violently to two things. That APR cap threat, which is highly political, and the $105 billion expense guide.
Right.
But we need to flip that narrative. What if JPM's willingness to spend isn't a weakness? What if it's exactly what creates the moat they need to survive these regulatory storms and absorb something like the Apple Card?
So the market sees a huge cost, you see a defensive wall.
They are literally building an impenetrable wall with cash.
I like that contrarian view. Okay, formalize it for us. What's the pitch?
The pitch is a regulatory bifurcation pair trade.
Okay.
The thesis is simple. Only the biggest players, the ones with scale, can afford the compliance and the tech costs to survive both technological competition and these targeted policy risks.
So walk us through the two legs of that trade, the short leg first.
The short idea. You short the regional or less diversified credit card issuers, the ones who rely heavily on those high subprime APRs for their revenue.
Because they can't pivot.
They have no tech budget, no scale, no other revenue streams to fall back on. If that APR cap passes, they are structurally brittle.
Okay, and the long idea is obviously JPM.
Precisely. You go long JPM as a long-term capital allocation bet. That huge $105 billion expense guide is the moat. They are spending to rebuild Apple Card, to survive policy shocks, and to compete globally.
They're making a bet that only the largest franchises will survive.
They're betting they'll emerge stronger, owning a much bigger share of what might be a smaller but cleaner market.
So, to recap then, JPM delivered an adjusted earnings beat powered by strong NII and markets, but got punished instantly for its aggressive 2026 expense guidance and the uncertainty around that credit card APR cap.
The core takeaway here is that JPM is explicitly choosing investment and scale over those near-term margin optics. They kept saying that profitability and ROE are outputs, not inputs you can just manipulate every quarter.
And the Apple Card deal is the perfect, very expensive example of that strategy in action.
Exactly. High cost, but they believe high reward.
A final provocative thought then for you to consider. Given how unified the banking industry is against things like the stablecoin loophole and these severe warnings about the APR cap, how much is the political climate alone, that regulatory hammer going, to dictate which financial institutions can even survive the next 5 years, completely regardless of their operational excellence? We'll leave you to mull that over.